Well, as I recall, and of course it's almost 11 years ago now, but I had a meeting with a pension fund head, and I was trying to raise money for a levered loan fund that we had that was in danger of getting a margin call and melting down. So we had to get more capital into that fund to protect it from a margin call. So I went back to my clients and I said, you know, we need more money, and the levered return on this fund is 22. So if you don't put up money here, it's like giving up some of your position. Mm-hmm. And she says to me, well, but what if there are defaults? And I said, well, you know, we've been in high yield bonds for, at that point, 30 years, and our average default rate has only been 1% a year. So if the return is 22, and you lose 1% a year to defaults, now you make 21, you have a great outcome. She says, well, what if it's worse than that? I said, well, the universe average default rate has been 4, so 22 less 4 is still 18. She says, well, what if it's worse than that? I said, the worst 5 years in history averaged 7.5. 12 less 7.5, 14.5, great outcome. She says, what if it's worse than that? I said, well, the worst year in history was 13. And by the way, when you have a default, you don't lose all your money. Let's say you lose 3/4. So 22 minus 3/4 of 13 is still 12. It's a terrific outcome. And by the way, in order to make 12% a year for the next 5 years, you have to have 13% a year defaults every year, and it's only happened once in history. And she says, well, what if it's worse than that? And I said to her, do you have any equities in your portfolio? And she said, yes, we do. I said, well, you better run out and sell them. Because if the world that you're walking me toward, everything crashes, equities are valueless. And the point is this. I think that one of the most important jobs of the investor is to not swallow whole the story you're told. Everybody tells these stories because they want to attract capital to whatever it is they're hawking that day. And our job is to be a skeptic. And when there's too much optimism, when somebody comes in your office and says, I've been managing money for 30 years, and I've made 10% a year, and I've never had a down month, your job is to say, that's too good to be true, Mr. Madoff. Everybody, after the fact, everybody knew that they should have said too good to be true. But of course, they applied wishful thinking. Yeah. But what I realized from that meeting is that when there's too much pessimism, the job of the skeptic is to say, that's too bad to be true. Right. The point of that meeting was there was nothing I could say which would satisfy her pessimism, and where we could reach a point where she would say, you know what, it's not going to get that bad. And if it's not going to get that bad, then today's the day to buy. Yeah. So that was the conclusion I reached. And if you think about it, see, most people operate under the misapprehension that changes in fundamentals cause changes in prices. Mm-hmm. But that's not true. That's not true. It's changes in fundamentals filtered through changes in psychology that produce changes in prices. You know, fundamentals kind of go like this. You think about the economy, a good year is up 4, a bad year is down 2. So the economy kind of goes like this. Mm-hmm. Companies are levered, so their profits kind of go like this, and stock prices go like this. Why do stock prices fluctuate so much more than fundamentals? Psychology. And, you know, in one of my memos, I wrote that and we saw this in the fourth quarter of last year, that in the real world, things fluctuate between pretty good and not so hot. But in the market, people go from flawless to hopeless. Mm-hmm. And when people think that the future is hopeless, meaning that asset prices incorporate zero optimism, then clearly prices are not too high, and all the surprises are likely to be on the upside.
So there's been a lot of, press has talked a lot about the mismatch of some types of securities, ETFs in particular, mutual funds in some instances, the liquidity of those structures, right, and the liquidity of the underlying securities.
Yes.
How big a concern is that for you?
It's not a concern for me because I don't expect liquidity. You know, you should not invest in fundamentally illiquid securities with the expectation of liquidity. And you shouldn't, in my opinion, you shouldn't invest in vehicles that invest in illiquid securities and expect liquidity. You know, I mean, people say, you know, we know that high yield bonds are illiquid, so I'd rather buy the high yield ETF because it's liquid. Now, how can the vehicle be more liquid than the underlying? So my concern is for the people who are investing in perhaps ETFs is the right thing to talk about, in the expectation of liquidity.
Right.
And I wrote a memo about liquidity, you probably read it, about 4 years ago. Yeah. And I said because then people were starting to talk about that since the banks could not position like they used to, that liquidity was declining. And I wrote that the best defense against illiquidity is to not need liquidity. Yep. You know, first of all, most trading is wrong. My son gave me a great quote at the time. Again, we were working on that memo, and he said to me, "Dad, if you look at the chart of a stock that's been up for 25 years, and you say, man, I wish I had that stock, think of all the days you would have had to talk yourself out of selling." You know, I mean, who holds a stock for 25 years? Who holds it from $1 to 1,000? That's how the big money's made. Yeah. But instead, people sell. Why do people sell? Either it goes down and they're afraid they're going to lose more, or it goes up and they're afraid that if they hold on, the prices will evaporate and they'll kick themselves. Yeah. So the point is, the best thing is to latch on to some very good long-term assets and hold on to them. That's the most important thing. Now, can you do better by adjusting your portfolio at the excessives once a decade? I think you can. Yeah. But that's not the most important thing. The most important thing is to be a long-time holder of quality assets. And so if that's true, then liquidity isn't that important. And most people are ill-served by being provided liquidity. A lot of the funds we run, you know, are 10-year funds. Yeah. And we do people a favor by denying them liquidity because we make it impossible for them to get out at the bottom. I'll tell you an interesting story. So in 1988, we started a fund that would invest for Japanese institutions in high-yield bonds. And 11 large Japanese institutions invested with us. And in the summer, August of '90, high-yield bonds had their first crisis. And they all called us up, and they said, we want our money back. And the price was about 80 cents on the dollar, which for a bond is a big fluctuation. So we said, unfortunately, you can't withdraw because the fund is closed end for 2 years. They said, okay. So then a few months later, the crisis was over. The bonds rebounded to par. The 2 years were up. We called them up. We said, now you can get your money back. It's at par. They said, no, it's okay. We don't want it. They only wanted to get out at 80. Once it was back to par, they didn't want to get out. And that's human nature. It's human nature. So the point is that, you know, the story about Hercules, and by giving up your liquidity with the part of your capital where you can live without liquidity, right. You're like tying yourself to the mast, yeah. Which is what Hercules did to get past the sirens. Yeah. And I recommend it.